Are you looking to secure your financial future, but don't know where to start? Stay with us, because in this video, we're going to reveal the best investment strategies for beginners, with concrete, quantified examples to guide you step by step. Theli-media is a universal medium covering a variety of subjects essential to everyday life, with a particular specialization in entrepreneurial training and finance. Our mission is to help you turn your dreams into reality, by providing you with the tools and knowledge you need to succeed in your projects. Don't forget to subscribe to our channel and activate the bell so you don't miss out on any of our upcoming investment tips. Let's start with the fundamentals. Let's say you have $1,000 to invest. If you put that money into a savings account with a 1% interest rate, after 10 years you'll have about $1,105. Not bad, but far from impressive. Now imagine investing that $1,000 in a stock portfolio with an average annual return of 7%. In 10 years, your investment would be worth about $1,967. That's almost double. Therein lies the power of compound interest. Compound interest allows your money to grow exponentially. The earlier you start, the more time your capital has to grow. One of the keys to investing is understanding that time and rates of return play a crucial role. Investing can seem daunting, especially when you're a beginner, but with a good understanding of the basic concepts and a well-defined strategy, you can turn your first savings into a successful investment portfolio. The first essential is to define your financial objectives. What do you want to achieve? Prepare for retirement? Buy a house? Build an emergency fund? Knowing where you want to go will help you choose the right strategy. Next, it's crucial to understand the principle of diversification. You've probably heard the phrase, "Don't put all your eggs in one basket." In investing, this means that you shouldn't invest all your money in a single stock or type of asset. Diversify your investments between stocks, bonds, index funds, and maybe even a little real estate, to minimize risk. For example, you could invest 40% of your portfolio in stocks, 30% in bonds, 20% in real estate and 10% in cryptocurrencies. This reduces risk while maximizing potential returns. A major obstacle for beginners is the fear of losing money. This is completely normal, but you have to realize that risk is inherent in investing. The key is to take calculated risks and never invest more than you're prepared to lose. With a disciplined approach, you can reduce this risk while increasing your potential returns. Now that you have an idea of the basic principles, let's look at how to apply them. An excellent starting point for beginners is to invest in index funds. These funds group together a set of stocks, allowing you to diversify your investments without having to choose each stock individually. For example, an S&P 500 index fund gives you exposure to 500 of the largest US companies. It's a simple and effective way to get started. Another strategy to consider is programmed investing. Rather than investing everything at once, you invest a fixed amount on a regular basis, for example, every month. This method, known as dollar cost averaging, reduces the impact of market volatility on your portfolio. You buy more shares when prices are low and less when they are high, which can smooth out your returns over the long term. What you need to remember is that investing is a marathon, not a sprint. It takes time, patience and a long-term vision to see the fruits of your efforts. Diversify your investments, stay disciplined, and above all, don't be afraid to start small. Every great investor started somewhere, often with little knowledge and little money. But what led them to success was perseverance, continuous education, and the courage to take calculated risks. Finally, let's talk about the power of reinvesting earnings. Suppose you invest in stocks that pay you dividends. Instead of cashing them in, you reinvest them. This reinvestment allows your capital to grow exponentially thanks to the snowball effect. Numerical example. If you start with $10,000 and earn a return of 7% a year, after 30 years, without reinvesting, you'll have about $76,000. But if you reinvest those gains every year, your portfolio could be worth more than $130,000 after 30 years. The important thing to remember is that to boost your income, You need to educate, persevere, and above all, never limit yourself to just one source of income. Diversify, invest, and don't be afraid to take calculated risks. So much for these strategies that can transform your finances. Thanks for watching this video on the best investing strategies for beginners. If you found these tips useful, don't forget to like the video and subscribe to our channel for more content on finance and investing. And if you want to go even further, I invite you to watch our next video on common mistakes to avoid when starting out in investing. See you soon, and don't forget, investing is the future.